Should silver fail to merely reach the standard of 2% that has persisted for 20 years out of the past 50 and instead achieves what occurred during bullish periods? When you examine that spread correlation in 79 to 80, it stood at 6. 5%, or during 2010 to 111, it climbed beyond 3%. That represents twice the current level. All right, so rather than 2% at a price of $8,000 gold, let's assume gold merely reaches the standard. What about 3%? What about 6%? Which occurred in the previous 2 bull cycles. We're experiencing a bull cycle currently. I believe silver won't ever crash again. It might crash. Suppose it climbs to $400 in 6 months and falls back to $250. Sure, it'll crash. But returning down to this previous reality won't happen. It's departing from it. It's advancing to substantially elevated levels. The extended debate surrounding silver has often emphasized claims of price manipulation, including historical regulatory proceedings and enforcement measures connected to market wrongdoing. Though this background offers valuable context, Michael Oliver has repeatedly maintained that the primary factor influencing the market currently is not historical manipulation stories, but a profound structural mismatch. For numerous years, silver has functioned in a continuing supply shortage, yet valuations stayed fixed within an obsolete band. Based on Oliver's analysis, this divergence permitted underlying tension to build, establishing circumstances where any eventual market reaction would be sudden and forceful rather than gradual and measured. What distinguishes the present climate, as Michael Oliver stresses, is the permanence and non-cyclical character of demand. Silver has progressed beyond its conventional role as a supplementary industrial metal and currently occupies the heart of rapidly expanding sectors like solar energy, sophisticated electronics, information centers, and wider electrification movements. These uses are mandatory rather than discretionary, and silver's distinctive conductive and material characteristics restrict viable replacement. On the production side, years of depressed valuations deterred capital allocation, resulting in output expansion unable to keep pace with increasing usage. Oliver observes that when markets disregard continuous shortages for excessive periods, the ultimate repricing tends to be concentrated in duration as valuations seek to reconcile with long-range fundamentals that were formerly overlooked. From a wider historical standpoint, Michael Oliver identifies similarities with other assets that stayed locked in antiquated price structures while connected markets progressed. Gold itself has demonstrated recurring patterns where lengthy consolidation was succeeded by forceful shifts that re-established valuation standards rather than return to previous bottoms. Silver currently seems to be experiencing a similar transformation, escaping not simply from its previous trading limits, but also readjusting its long-standing connection with gold. In these stages, Oliver warns that traditional indicators frequently lose significance. Volatility amplifies, and dramatic price fluctuations should be interpreted less as disorder and more as proof of a market correcting toward an elevated and more authentic equilibrium. Now we share the segments from Michael Oliver's conversation. Before we proceed, please subscribe to our channel and enable the bell icon to get prompt notifications. Thank you, and enjoy the content. I'm uncertain what's been holding silver back, except that we do understand there has been intentional effort to suppress it, banks and such. And I think there's genuinely been some convictions, and market convictions, Justice Department and so on, of effort several years back, of effort to, control the market. So, but we don't examine silver from that perspective, the fundamentals. So we understand we have a production consumption shortage. We've experienced that for 5 years. Why is silver only currently reacting? Well, accumulated tensions, the persistent demand by China, crucial for their solar arrays. They're 80-90% of the worldwide solar array manufacturing, and silver is crucial in that. And additionally, we hear constantly about these AI information facilities, energy facilities and so on. Well, silver's crucial in that here, there, and everywhere in micro format and bigger format. You cannot eliminate it. It's crucial because of its character of the metal. And therefore, those demand elements are persisting to expand, and it's not been factored into silver, the production consumption problem. And thus, if it's committed an error and not already reacting to that by gradual increase to respond to that persistent demand, which it's not accomplished, then when it adjusts, it simply does it in a frenzied manner. And genuinely, it's logical because it moves from point A to point B, where it ought to have been, regardless, perhaps 10, 20 years earlier, and does it in a rapid format. And copper executed it, lead executed it, gold executes it every bull cycle. In reality, a consideration about gold currently, the parent metal, it's not a chiefly industrial. It's principally money. All right, you had of the previous 50 years since the administration authorized it, quote unquote, you had the bull cycle. It topped in 2000 but declined into 1975 when it was authorized. Once it was authorized, it topped and declined to $103 in mid-1976. That was a bear bottom, 50% retracement. From that 76 bottom at 103, it climbed to 850 in 3.5 years. Eightfold increase, bear bottom, bull peak. Then for numerous decades, it moved laterally, but where the $23,400 mark, all right, considerably off the 850 peak, but still significantly above the previous reality. It existed in the 1970s and so on. In 2001, it established a bottom at approximately $260, and a decade afterward, it was 1920. Another eightfold shift, bear bottom, bull peak under circumstances that aren't remotely approaching the fundamental realities that are currently underlying gold. All right, gold's bear bottom this round was in 2015 at 150. Eightfold is approximately about 8,500. All right, we're 4,500. We're only a fourfold shift. We're only half the magnitude of the earlier two bull cycles. What if gold executes it again, which is barely like a surprising thing to experience another eightfold shift? All right, major development. Wow. Where would silver be if, let's assume, silver currently surges up to, let's assume, 2%, even an ounce of gold? Oh, incredible. What would that be? 8,000 gold, 2%. You grasp the concept. What if gold doesn't halt at its previous eightfold shift again, because something distinct's occurring this round? And what if silver, rather than advancing to where it's been in the previous 50 years, that connection has at minimum been 2% in 20 of the previous 50 years? Calculate silver into gold, at minimum been 2%. We witnessed a bottom this year at roughly 1%. Extremely cheap, free silver relative to gold. Understood? If silver doesn't merely advance to the standard of 2%, which it's been 20 years of the previous 50, and executes what it achieved during the bull movements. When you examine back and observe that spread connection in 79 to 80, it was 612%, or during 2010 to 111, it climbed beyond 3%. That's a multiplication from where it stands currently. All right. So rather than 2% of the valuation of $8,000 gold, let's assuming gold only executes the standard. What about 3%? When about 6%? Which is what it executed in the previous two bull cycles. We're in a bull cycle currently. So wouldn't the spread advance up and at minimum challenge the spread connection it held in 1980, 2011? Heck, valuation is beyond those peaks. Why shouldn't perhaps the spread connection also advance up and challenge those peaks? So the limits come off silver both in its connection to gold and its own technical condition. So it's a giant, and if you don't approach it that manner, and if you approach it like, oh, RSI is excessive, you'll lose the shift. In reality, the reality is that if you execute monthly RSI, a popular so-called momentum measure, we disregard it, but it's popular in the 79 to 80 shift RSI on a monthly foundation got beyond 80%, which is the, overextended mark for a year. So when it initially got to 80%, if you declared, oh, I'm finished, it's overextended, you lost the complete shift from like the teens to 50, all right? You lost the entire thing by utilizing a traditional momentum measure that said, oh, I don't want to chase that, it's overextended. And so a crucial aspect regarding silver is not to approach it like you approach normal securities, normal commodities, because it's neither. It behaves like gold and possesses both industrial and monetary characteristics. It straddles those dual realities. Throughout my 4 decades of technical examination experience, I've observed that when this happens, volatility is exceptional, and these shifts are ferocious and violent. You experience these phases where commodities might advance 300% in 12 months, 18 months, like copper executed recently. Silver's capable of that style of shift, and I believe it's initiating one currently. The broader framework, the underlying structure beneath this entire precious metals cycle, and specifically what's occurring with silver currently, involves numerous components. One component is the debt scenario. We understand central banks globally, specifically the Federal Reserve, are buying treasury bonds like there's no tomorrow. The Bank of Japan is purchasing bonds and attempting to stabilize their bond market because when bonds decline, yields climb. When yields climb on long-dated debt, that's harmful. It impacts commercial property, influences numerous asset categories, and thus they're attempting to stabilize it. I personally monitor the 30-year Treasury bond contract. It functions like the sleeping giant. Everybody assumes everything's stable because stocks are still advancing. But he's resting. He could execute violent actions. It's been 118 to 114.12 for since November. Currently, we're trading at 116. All their purchasing has not elevated the bonds. They've simply gone completely sideways in valuation, indicating the returns on 30-year are at the peaks, simply remaining there, not declining back down. No comfort on long-dated debt and segments in the equity market like commercial property, which is a massive segment, which is very weak sector, has been moving sideways in the center for the previous year, in the center of its 10-year band. It hasn't established new peaks with the S&P. It hasn't collapsed yet. Everyone assumes, oh well, it hasn't collapsed. It must be all right. Monitor the T-bonds, because if they decline over like they're 116 currently, you don't ever desire to witness 111 again. You examine a valuation chart and declare, well, we've witnessed 110. What's the major concern about 111? Our momentum framework say you arrive there, you're going to experience an implosion. Currently, admittedly, they're going to emerge with fire equipment back at Japan, Fed, etc. Central banks are going to go frantic, and they're going to create money like frantic. Well, what's the recipient of them destroying the money unit? Gold, silver, actual money benefits from the deterioration of fiat money. And that's the chronicle of gold and silver as well. So that's the other surge beneath here. And monitor the T-bonds, because if they can't regulate that market and it drops simply a handful of points on the T-bond contracts, we're examining March contracts currently, 30-year bonds, they're 116. You don't desire to drop off even a couple points, specifically 4 points, because they're going to explode the foundation out of it. You're going to experience a panic in the bond market, which isn't on anybody's radar currently. Everyone's examining what's NVIDIA executing. All right, who's concerned? Yeah, NVIDIA ultimately is going to settle the debt for being the excessive sector, the AI sector, but it probably won't be the initiating one. And honestly, currently, we perceive the equity market is steady and likely on an intermediate foundation to probably even advance a little bit more. Maybe reach well into the initial quarter before we witness any decline at all. And I don't perceive by the manner what a lot of gold and gold miners participants are concerned of. Oh, if the equity market declines, we decline. No, it doesn't. A handful of times in Chronicle, gold and miners suffered. October of 2008 is the most conspicuous single exceptional month where the equity market, already a year off of its bull cycle peak, already considerably off of its bull cycle peak, which is October 2007. All right, so October 2008, it experienced what you could designate a crash month, and gold and silver joined and initiated the miners, and gold reversed around within a handful of months, was back to the peak new peaks. Equity market persisted down through 2009, but had occurred after that crash in October of 2008, which did gold, was ready for a correction at that moment by the manner. It had been climbing up massively for years, and thus it was due for a nice dramatic break. And thus it experienced one, and everyone assumed, oh man's the conclusion of gold. Up. In a matter of months, it was back, establishing new peaks, and S&P persisted down. So that misconception concluded. Yes, there was a 1 month that emerged as in harmony. But examine what occurred January through April. Gold climbed, equity market collapsed down this year. How come gold didn't crash? Gold advanced up. Like, what did gold execute? It topped in April 3,500. Equity market established a bottom. They weren't in harmony. I don't believe the equity market in the US is about to experience a crash-style occurrence. I believe what's more probable to occur in our evaluation of the S&P and the NASDAQ is that this upside crawling attempt that we've experienced for like 4 months currently, where every month you obtain the S&P up beyond 6,900 and it declines off but doesn't advance anywhere. 6,900 4 months in a row, I believe you'll probably obtain beyond 7,000 and continue on. Who understands, maybe we obtain a judgment from the Supreme Court on Friday that declares we're going to obstruct the tariffs in some manner. And the market assumes, oh, excellent, it advances up. It doesn't appear correct technically to decline over yet. And when it does decline over, I don't perceive the risk of a rapid decline over at this moment. I'm suspecting I'm going to need to reach into the second quarter before the S&P ever returns back down to figures that we would characterize as, the foundation comes out. And those figures are down considerably below where we are currently. We need to reach in the mid 5,000s again, like 5,600, before you activate figures that declare, all right, I can implode. And thus, I believe the S&P is probable to advance up for a handful more months, which indicates, hey, if you're in gold miners, no issue from the equity market. If you trust in that correlation misconception, which is very handful examples in Chronicle validate that by the manner. And even when it does decline over, I don't perceive it being sudden and dramatic until you return back down toward those marks. Remember, in April, we reached to 4,800 on the S&P. I'm stating if you return back down currently to 5,600 anytime this year, the foundation could emerge out. But that's a considerable distance down there, and the procedure of reaching there could be laborious, indicating not panicky, which indicates probably if you're utilizing that as your alarm consideration that I'm in gold miners, I need to be alarmed of the equity market. I wouldn't be alarmed. I don't believe you're going to obtain drama out of the equity market on the downside until you return back to that mark. And that could be a procedure. We may be well into the 6-month time frame of the silver explosion, with miners also exploding and the equity market still simply stable and no danger to the miners. Anyway, that's my consideration on that problem, is that the equity market's not a danger currently. It is a danger if you're a participant. I don't believe you should be long the equity market. I believe it's topping. It's been topping since January. I believe the new peaks are simply teaser peaks, which also occurred in 2000, and in 2007 you appear like you topped and established a new peak about 10-15%, and a year afterward you collapsed apart regardless. So from an asset standpoint, if you're in miners as a category, and I emphasize them currently too, I believe they're going to exceed gold going forward this year. I believe they're going to be the superior place to be. Then gold is simply like silver is going to be superior than gold. But I don't believe the equity market is a danger to them at this moment. Examining ahead, the path for gold and silver indicates to sustained strength powered by both structural demand and systemic uncertainty in worldwide finance. Production constraints, specifically in silver, are probable to maintain upward tension on valuations as industrial and technological usage grows faster than mining production. Participants may witness intermittent corrections along the path, but these are anticipated to be brief pauses rather than reversals as the fundamental forces driving metals elevated stay solidly in position. The present climate benefits those who concentrate on long-range positioning, seizing opportunities during temporary declines rather than attempting to schedule every short-range fluctuation. Meanwhile, gold is anticipated to preserve its function as a protection against currency and debt disorder. With demand from both institutional and retail participants persisting to climb, the expanding gap between actual assets and traditional paper-based instruments indicates a wider reallocation of capital, which could enhance gains for metals over the approaching months. Market volatility is probable to escalate, but this is part of a recalibration rather than a collapse. Silver in specific is positioned for disproportionate performance relative to gold as industrial necessity and shortage unite, indicating that the next stage of this metal pattern could witness rapid and substantial price acceleration that redefines long-range valuations. Let us understand what you consider in the comments. And if this content provided new perspective, don't neglect to like, share, and subscribe for additional updates on this developing monetary transformation.